So we made it to another decade. It is 2020, guys. And many of us are already on our financial independence journey. We're already saving, anywhere from 40 to 50% of our income, and we're already investing. However, there's a lot of people out there that look at our content on a daily or weekly basis and they don't know where to start. They don't know how to begin investing. They don't know exactly what we mean by financial independence and how to get on this journey with us. So, I want to share 5 steps that anyone can use in order to start investing and become, part of this financial independence community with us and get on this journey along with us. The first thing I want to talk about is what do we mean when we say financially independent? Financial independence is when we have enough income to cover our expenses and we don't have to work a 9 to 5 or we don't have to depend on anyone else for income in order to live our daily lives. Now, one of the most common ways that a lot of people are reaching financial independence is through starting a business that is paying them or generating them enough money where they don't have to be present in the business daily. However, they are still making money and they're able to generate enough income to, fund their lifestyle, to pay for their bills, and to have money to do the things that they want to do. Now, for those of us like me who have not started a business yet, there are other ways that we can reach financial independence. And what I'm going to be talking about today is through saving and investing. The first step to beginning investing and reaching financial independence is to have a budget. There is a saying that I always, talk about, and that is what is measured is managed. Budgeting is not about not being able to spend money. Budgeting is about telling your money where to go, assigning each dollar a job, and putting your money to work correctly. It's about knowing how much you're spending on your expenses, such as your housing, your food, mandatory bills. It's also so that we know if we're overspending on things and we're able to look at things that we can cut out, unnecessary expenses. Once we have a budget in place, we now have clarity on if we have enough money to save and if we're able to begin investing. Before we begin investing, as we're creating a budget, we also need to adopt the habit of paying ourselves first. And what that means is that we're going to allocate a set amount of money or a set percentage of our income that we are going to fund into a separate high interest savings account. You want to try to get a savings account that you can earn at least 2% or more interest. However, I would say the average right now is anywhere from 1.6% to about 1.8%. And you also want to make sure that you have an emergency fund. As Dave Ramsey suggests, you want to maybe start out with funding your emergency account with $1,000. And once you've reached that goal, then you can work your way to having 3 to 6 months of expenses. Now that you have a budget in place and you know how much you can afford to save and how much you can afford to invest, now you know your numbers and you have clarity on your financial situation. So you can head to step 2 of this financial independence journey. Step number 2 is paying off debt. Because I got on my journey to financial independence kind of late in life, I started this journey, around the age of 35, and I did not start investing until that time. I know the importance of putting our money to work. The longer that we invest, the more our money can compound and grow. So I believe that you could still invest while paying off debt. However, many of the experts and people such as Dave Ramsey suggests that you first pay off your consumer debt before you start investing. Now, if you can get your money to working as soon as possible, that is definitely a plus. However, if you're low on cash and you're kind of, tight in your budget, you may want to just focus on paying off debt first. And maybe once you get some of your debt paid off, or if you're able to earn additional money, or maybe pick up a part-time job or create some type of side hustle for yourself where you have extra money, you can also begin to invest as you're paying off your debt. Now, consumer debt such as credit cards with high interest rates, anywhere from 20 to 24%, you definitely want to go ahead and get those things paid off as soon as possible. But there are also things that are considered to be good debt, such as a mortgage on your home or maybe a rental property that you're buying. Those things like that, if you can include investing into your long-term financial journey, I don't see any harm with you investing as you're paying off your debt, as long as you can afford to, because we must remember that there are risks in investing. And once you begin your investing journey, you don't want to have to take the money out of your investment accounts that you started investing. You want to be able to leave that money there so again it can grow, compound, and that money can work and compound on itself and grow for you to, reach financial independence. And for those of you who wish to retire early, you're able to do so at the time that you set for yourself. Step number 3 is do your research. You now have your budget in place. You know exactly how much you can afford to invest. You begin the journey of eliminating any debt that you need to pay off. Now you have to decide what type of investor you are. The first thing that you want to figure out is, are you an active investor or a passive investor? Now, an active investor is those who have a higher risk tolerance. They're willing to keep a close eye on the market and the trends, and also they're willing to pick stocks or assets that they want to invest in. Now, when it comes to being a passive investor, those, they want to use indexes to track the market. They also want to use the set it and forget it strategy. They have, a lower risk tolerance, and their investing approach, like I said, is more of a, invest maybe once a month or every quarter or even once a year, but they want to be able to invest in funds that they set it and they don't have to worry about it anymore. Now, in addition to passive investing and active investing, there's also something that is called a growth investor. Now, someone who is a growth investor, they may invest in things like, the technology sector, things like Amazon or Google or Tesla. These type of stocks, they either pay a very small dividend or no dividend at all. And these investors, they're investing for capital gain. They expect these companies to have a fast and higher growth in their earnings, and they're expecting to sell out of these assets in order to make money. Next is your value investor. And a value investor, what they do is look for undervalued stocks. They expect these stocks to grow their earnings, but they want to buy these stocks while they're undervalued. And by the time that they increase their stock price, again, they may sell these assets in order to collect the capital gains on these stocks. Now, last but not least is your income investor. That's kind of like what I consider myself to be as an income investor. Income investors, they look for assets to generate steady income, such as stocks that pay dividends with a consistent or higher dividend yield, or they might invest in bonds. Now, no matter what your investing strategy is, the important thing is that you know if you're trying to maintain your wealth or you're trying to generate additional income through your investing strategy. Step number 4 is asset allocation. Many will recommend that new investors start out with either mutual funds or index funds. Me personally, I prefer index funds over mutual funds. Now, if you're not familiar with what a index fund is, it's a portfolio constructed to match or to track the market indexes such as the S&P 500. It gives investors a broad exposure to the market. They also usually provide low expense ratios as well as low portfolio turnovers. Now, in addition to index funds, there are also ETFs or an exchange traded fund. Now, an exchange traded fund is very similar to a stock. It is a basket of assets like stocks, commodities, or bonds. The price fluctuates up and down, and again, it trades on the stock market, such as a stock does. If you're going to own individual stocks, I suggest that you be sure to do your research, and this also applies to owning index funds and ETFs. It is important that a new investor understands balance sheets, income statements, dividend yields, also the events of the market, as well as management fees. You can purchase these assets through online brokerages such as Webull, SoFi Invest, and Robinhood. If you're interested in opening an account with any of these online brokerages, I do have a link in the description below where you can receive free stocks or even money towards starting your investment portfolio. Now that you've created a budget, you begin paying off your debt, you've done your research, you've set your asset allocation, and your investing portfolio is now built. Now it is time to go to step 5, which is to automate your investments. You want to be sure that you stay on track to reaching your goals, and you want to be consistent with your investing, and you want to make sure that you're sticking to your investment strategy. And the best way to do that is to automate your investments. Now, we want to make sure that our money isn't losing value and it's being put to use the correct way. We don't want to just have our additional money sitting in a bank account where it cannot work for us, where it cannot compound correctly, and where it cannot grow at the rate that it should grow. In order for us to avoid this, it is so important that we automate our investments. Whether you decide to invest weekly or on a month-to-month basis, maybe even quarterly or even once a year, just be sure that you have your set dollar amount that you're going to be funding your investment portfolio with be automatically drafted into your investment account so that you're able to stay on track, reach your goals, and obtain financial independence. To recap those 5 steps, step number 1 is know your numbers. Step number 2 is become debt free. Step number 3 is do your research. Step number 4 is asset allocation. And step number 5 is automate your investments. Anybody that you know looking to begin investing or to get on their financial independence journey, make sure to share this video with them or share this video on your social media sites for anyone who may have questions about how to start investing or just looking to change their financial situation. I am Marie Brown. This is my channel, Minds in Motion, where we talk about personal finances, investing, and how to become the best version of yourself. Be sure to like the video, comment below with any questions, hit that subscribe button and that bell notification so you know when I post other videos such as this one. Thank you so much and have an amazing day.